Meantime, Goldman lowering its odds of a U.S. recession in the next 12 months from 20% to 20% from 25%. And joining us to discuss that call is Goldman's chief economist, Jan Hatzius. Jan, great to have you, even remote. Thanks for being with us.
It's good to be here. Thank you.
I had to think on Friday when I read your note that retail sales and claims must have been pretty decisive for you to trim your odds so quickly after raising them.
Yes, I think they were definitely encouraging data points. Claims the last couple of weeks, retail sales, plus 0.7% if you take core retail sales and translate them into real numbers, inflation-adjusted numbers. But I think in general, the last couple of weeks have basically said that the economy is still doing fine. And, typically when recessions occur or when risk is really rising sharply, things happen pretty quickly. So if you see a couple of weeks of data that say the economy is still doing fine, you want to put some weight on that. So we went from 15% to 25% after the employment report. We've now taken that halfway back to 20%. And we also said that if the August employment report that's coming up in early September, if that is okay or better, we'll probably take it back to 15%, which is the long-term sort of unconditional average probability of recession.
Right. That said, you do point out that a lot is riding on the August jobs number. We all know what's happened to the unemployment rate coming off the cycle low. Do you think it's important for Powell to frame a cut on Friday in a way that would make a 50 basis point cut, for example, not seem frightening?
I think he's not going to be specific in terms of the moves that are coming. I'm sure his comments will be consistent with the idea that the risks are more two-sided and there are some signs of softening in some areas. And more importantly, or as importantly, inflation has come down. I don't think he's going to let himself be, nailed down in one way or the other. I think if the data support 50, they should do 50, and I think they will do 50. But I think it's much more likely that things will look good enough for a series of 25 basis point cuts to do the job.
Do you think that the 50 is necessary to your projection for a recession? Does that have any basis on kind of whether you lower it down to 15%? I know you mentioned that the September 6th jobs number needs to look reasonably good. I'm just trying to get a better understanding of kind of what would bring that number down to 15%. Is it the combo of cuts and a good jobs number and good data, or what are you looking at from here?
No, it's really the data. So if the next report basically provides a real counterpoint to the last report, say via a decline in the unemployment rate that undoes some of this increase, then I think that would be a reason to go down to 15%. Obviously, we'll be looking at a broader range of indicators, not just the unemployment rate. The payroll numbers are important too. But I would say the unemployment rate has been so in focus that will be our main, our main perspective and the thing we look at most.
We had a discussion with Jim this morning, Jan, about auto delinquencies and trying to remember in what order people try to pay their bills and what's most important. It's happening at a time that these rise in delinquencies, even as credit card delinquencies, don't seem to be rising as quickly. I guess just sort of characterize your level of worry on that front.
I think there have been some weaker indicators. Even in auto delinquencies, it depends on which indicator you look at. The New York Fed has a quarterly survey of household credit and credit quality, and that actually showed slightly better numbers in the second quarter. But then there are other data out there that also include additional issuers that have looked worse, you're right, and that is something that needs to be watched. My overall view, though, on the consumer is that the consumer is still hanging in there, and I'm basing that not just on the official retail sales data, but also on the earnings reports for the second quarter, where the overall message from companies on the consumer was still okay, despite some weakness at the bottom end. But overall, it wasn't too bad.
If the consumer is holding up so well, what do you think would be the rationale for doing a 50 basis point cut?
Well, I think the rationale is mainly that the economy no longer needs a 5 handle on the funds rate. And inflation has largely moved back to the Fed's target. The 3-month average core PCE inflation rate at an annual rate, we think, is probably going to be below 2% when the July numbers come out later this month. And the risks are somewhat more balanced. 5 3/8 is clearly a high level for the funds rate, and they should be moving away from that. So I think that would be rationale for doing 50. Now, I also know, and Chair Powell hinted at this in the last press conference, that they prefer to move more gradually. And I think it's also perfectly defensible to deliver a series of 25 basis point cuts.